The U.S. real estate market has always been one of the most closely watched sectors of the economy. Whether you're an investor, a homeowner, or simply someone curious about housing trends, understanding how the market is moving can help you make smarter financial decisions. But here's the challenge. Real estate is not just about prices going up or down. It's about demand and supply, mortgage rates, government policy, buyer psychology, and even global economic conditions. In today's video, we'll break down the latest real estate insights using multiple trusted sources, so you don't have to spend hours digging through complex reports. By combining data from the National Association of Realtors, NAR, Zillow Research, Redfin's Data Center, CoStar Group, and the Federal Housing Finance Agency, FHFA, we can piece together a bigger picture of where the housing market is headed. For example, NAR provides a reliable pulse on existing home sales across the nation, giving us a sense of how active buyers and sellers are in different regions. Meanwhile, Zillow Research offers valuable metrics like the Zillow Home Value Index, which helps us track home prices with clear, easy-to-read charts. On the other hand, Redfin Data Center brings us something unique, real-time transaction insights, such as how quickly homes are selling or what percentage of listings are cutting their prices. If you're interested in commercial properties, CoStar Group is a key player. Their research into office buildings, retail centers, and industrial properties sheds light on where businesses are moving and what that means for the economy. And finally, for those who want a more academic or government-backed perspective, the FHFA publishes the House Price Index, one of the most authoritative measures of housing affordability and appreciation nationwide. By weaving together these different perspectives, our goal is not just to share numbers, but to answer the question, what do these numbers actually mean for you? Whether you're thinking about buying, selling, or investing, this video will give you a clear, data-driven outlook that helps you stay ahead of the curve. Part 1. Luxury Market Boom. When most people think about the U.S. housing market today, they think about high mortgage rates, falling affordability, and cautious buyers. But at the very top of the market, the story is completely different. In fact, the luxury housing sector is not just surviving, it is booming. And nowhere is that more evident than in some of Texas's most exclusive neighborhoods. Let's begin with Highland Park, one of the most iconic luxury enclaves in Dallas. Here, the median home price has climbed to an astonishing $2.545 million. That represents a 22.3% increase compared to last year. For wealthy buyers, demand has not slowed down. In fact, it has only intensified. Just next door, in University Park, prices are holding steady at a median of $2.125 million. The year-over-year growth is modest, just 0.7%, but the stability itself tells a story. University Park remains one of the most reliable, prestigious areas in Texas, where families and investors are still willing to pay for safety, community, and long-term value. But the most dramatic surge is happening in Westlake. Here, median prices have reached an almost unbelievable $8.7 million. That's not a typo. This represents a 218.7% jump in just 1 year. To call it a boom would be an understatement. Westlake has become a magnet for ultra-high net worth individuals, corporate leaders, and global investors who see these properties not just as homes, but as trophies, symbols of status, wealth, and permanence. Meanwhile, in Southlake, another affluent suburb, prices are more modest but still impressive. The median now stands at $1.29 million, with a 2.9% increase year over year. Southlake continues to attract affluent families who want proximity to Dallas-Fort Worth's business centers while enjoying suburban luxury and top-tier schools. So what explains this boom at the top end? The answer is simple: cash. While the rest of the housing market is being squeezed by rising mortgage rates, luxury buyers are playing by a different set of rules. In these neighborhoods, more than 50% of transactions are all cash deals. That means buyers are writing checks worth millions of dollars, bypassing lenders entirely. Think about that for a moment. When mortgage rates are climbing to their highest levels in decades, most buyers are forced to reconsider their budgets. But in the luxury market, the conversation isn't about rates at all. It's about liquidity. If you have the money, you simply buy. And sometimes, competition pushes things even further. In one remarkable case, a buyer didn't just meet the asking price. They paid 122% of the listing price, entirely in cash. That kind of bidding war shows just how aggressive this market has become. Wealthy buyers aren't negotiating. They're competing to win, and speed matters more than saving a few $100,000. The key takeaway here is that the luxury segment is operating in its own universe. While much of the U.S. housing market is cooling, these top-tier neighborhoods are hotter than ever. Prices are rising at double or even triple-digit rates. Supply remains extremely limited, and all cash buyers are setting the tone. For investors, this is a reminder that real estate is not one-size-fits-all. Luxury properties are less sensitive to interest rate shifts and more influenced by global wealth flows, lifestyle preferences, and scarcity of truly elite homes. As long as wealthy buyers continue to chase exclusivity, prestige, and security, the luxury market will remain not just resilient, but unstoppable. Part 2. Mid-tier market shaken up. Let's zoom into one of the most sensitive segments of the housing market, the mid-tier range between $600,000 and $1 million. This is the bracket where families often stretch their budgets, expecting strong job security and future income growth. But right now, this tier is being hit the hardest. Across Collin County, covering cities like Frisco, Salina, and Prosper, home values have started to slide. Many listings are seeing price cuts of 20% or more, with some neighborhoods even experiencing what buyers are calling a mini crash. Why is this happening? There are several key drivers. First, the tech layoffs. Texas has recorded over 1,081 layoffs in the past year, and strikingly, 334 of those were right here in Dallas. These aren't just numbers on a spreadsheet. They represent highly paid professionals, people who were prime candidates for mid-tier homes. When their jobs vanish, so does their buying power. Second, the move-up buyer freeze. Normally, people who already own smaller homes sell them to step into these mid-tier properties. But with layoffs and uncertainty, many have canceled contracts, unwilling or unable to move forward. In Dallas alone, the cancellation rate for pending sales has jumped to 17.7%. That's nearly 1 out of every 5 deals falling apart before closing. And third, migration patterns are shifting. For years, North Dallas, particularly Collin County, was the hot destination. But now, we're seeing families choosing to head west and northwest instead. Places like Argyle, Northlake, and Justin are gaining traction. Why? The comparison is pretty straightforward. Take Salina and Prosper. These areas are grappling with heavy traffic congestion on Highway 380, higher property taxes, and overall rising living costs. They've become victims of their own popularity. Demand pushed prices up, but now affordability is backfiring. Meanwhile, Argyle and Northlake are offering a very different proposition. Less population density, smoother commutes, lower taxes, and more reasonable home prices. Here's an example that speaks volumes. A home in Salina listed at $879,000 could easily have a comparable property in Northlake priced at just $698,000. That's a difference of nearly $200,000 for a lifestyle that may even feel less crowded. This dynamic is creating visible migration arrows on the housing map. Families leaving the once booming North Dallas suburbs and planting new roots further west. To sum it up, the mid-tier market is shaking, not collapsing everywhere, but undeniably under stress. Prices are adjusting, buyers are hesitating, and new migration patterns are redrawing the map of Dallas housing. The big question remains, will this correction stabilize quickly, or are we seeing the start of a longer-term realignment? One thing is clear. Buyers in this price range are becoming far more cautious, and sellers are learning that yesterday's prices may no longer work in today's market. Part 3. Entry-level market. Strangled. Now, let's turn to the segment that feels the pressure the most, the entry-level housing market. For many young families, first-time buyers, and working professionals, this is supposed to be the gateway into the American dream. But instead of a welcome mat, what they're finding today is a locked door. Over the past 25 years, the price of entry-level homes has risen by a staggering 197%. During the very same period, household incomes have grown only about 40%. The math simply doesn't add up, and for new buyers, it's devastating. Think about that imbalance for a moment. Wages are crawling while home values are sprinting ahead. What used to take a few years of saving now feels like an impossible climb. And that climb becomes even steeper when interest rates shift. For the entry-level market, mortgage rates aren't just numbers, they're lifelines. A single percentage point increase can push a home out of reach for thousands of families. Unlike luxury buyers who can absorb higher borrowing costs or even buy in cash, entry-level buyers live and die by the monthly payment. And the market is showing signs of strain. Builders who once sold homes almost instantly are now forced to roll out incentives just to keep demand alive. Across Texas, and especially in the Dallas metro, we're seeing discounts, price cuts, and even temporary interest rate buydowns offered at the sales office. It's a desperate attempt to keep first-time buyers from walking away. Still, even with these promotions, many families are left gasping for air. Rising insurance premiums, higher property taxes, and the cost of everyday living only compound the problem. Here's the stark contrast. Luxury buyers remain largely unaffected. They have the means, the cash reserves, and the stability to navigate this market. Entry-level buyers, on the other hand, are being squeezed the hardest. They're the ones who feel every ripple, every rate hike, every cost increase. The result? A generation of would-be homeowners who are either delaying their purchase or giving up entirely. Instead, they remain stuck in rental markets that are themselves heating up, further draining their ability to save. To visualize this, imagine a simple bar chart. On one side, income growth, up just 40% in a quarter century. On the other, home prices skyrocketing nearly 200%. The gap between the two isn't just a statistic. It's the story of why so many Americans feel left behind. This widening divide raises a troubling question. If the entry-level market remains suffocated, what happens to the housing ladder as a whole? Without new buyers coming in at the bottom, the entire system risks losing balance. For now, the pressure remains acute. Builders will keep experimenting with incentives, buyers will keep chasing affordability, and policymakers will debate solutions. But for the young couples touring open houses this weekend, the reality is painfully clear. The first step into homeownership has never been more out of reach. The entry-level market isn't just tight. It's suffocating. And unless something changes, this segment will continue to carry the heaviest burden of America's housing crisis. Conclusion and advice. Dallas doesn't have just one real estate market. It has three parallel economies, and they're moving in completely different directions. At the very top, the luxury segment is booming. Prices in Highland Park, University Park, and especially Westlake are breaking records. Wealthy buyers are writing checks for multi-million-dollar homes, sometimes paying well over the asking price, and mortgage rates simply don't matter to them. In the middle, the mid-tier market is wobbling. We're seeing cancellations, price drops, and a wave of uncertainty triggered by tech layoffs and affordability issues. Families trying to upgrade into bigger homes are stuck, unable to sell their existing property, and that gridlock is weighing heavily on the $600,000 to $1 million price range. And at the entry level, the story is even tougher. First-time buyers are being squeezed the hardest, caught between soaring prices and stagnant wages. Even with builders offering incentives, this group is finding it harder than ever to step onto the property ladder. So what does all this mean? It means that 2025 is shaping up to be one of the strangest years Dallas real estate has seen in decades. You'll hear headlines that shout, "Dallas is exploding," or "Dallas is crashing." The truth? Both statements are misleading. The real story lies at the micro level, in specific neighborhoods at specific price points, within specific buyer pools. That's why, if you're looking to make smart decisions in this market, you need to change the way you think. First, don't get carried away by the hype. Just because a luxury neighborhood is surging doesn't mean the same is true for the broader market. Second, Don't panic when you hear bad news. A crash in one price tier doesn't automatically mean every buyer is in danger. Third, focus on the data, neighborhood by neighborhood, segment by segment. Look at median prices, inventory levels, and buyer behavior in the exact area where you want to buy or sell. Because in a fragmented market like Dallas, opportunity isn't evenly distributed. Some buyers will find incredible deals, while others will overpay simply because they didn't do their homework. The bottom line is this: Dallas is no longer a one-size-fits-all story. It's a market of contradictions, booming at the top, shaky in the middle, suffocating at the bottom. And that complexity demands a smarter, more careful approach. If you want to succeed, you can't rely on generalizations. You can't just take headlines at face value. You need to analyze, adapt, and act with precision. So as you move forward in 2025, remember this: ignore the noise. Don't be ruled by fear. Study the micro markets. Do that, and you'll not only avoid the risks, you'll uncover opportunities that most people will miss. Because in today's Dallas real estate market, the smartest strategy isn't about chasing the trend. It's about seeing clearly through the chaos. And that's what will set you apart in 2025.